All right, thanks for your patience. Well, I have the pleasure today. I'm going to move around so we can see the ARC logo. I want to first start off by saying many thanks to our presenting sponsor, American Reporting Company, Mike Olden and Francois, and all the good folks there who are ambassadors for our industry and great colleagues and friends. Mike, can you hear me?
Yes, Andy, I can.
Awesome. Hey, if you don't mind, Mike, I'd love for you to share. I know that you helped lead the charge on this presentation. We're excited to welcome Ari Karen from Mitchell Sandler. And I know, Mike, you have seen a similar presentation in the past. Is that right?
I did. It was about a month or so ago, Nashville MBA put this on featuring Ari. And Ari's been a great colleague for, gosh, over 10 years. And I met him several years ago. He was always involved with the state and local workshop for MBA. And that's where I first met him. And just another plug. Every month on the first Friday of each month, Ari and his colleague Daniela from Mitchell Sandler have the lender legal line call. And it's about a 30-minute call, and it's always full of important information. And Ari, maybe you can also talk a little bit about that and your upcoming. I know you have another upcoming one related to the Federal Trade Commission and some of their stuff later on there. But we're delighted to participate in this. I think it's going to be great information for everybody today.
Yeah, thanks, Mike. Not only great, but incredibly timely information, I would say. We do Tuesdays on tour. We go out every Tuesday and we preview the Brokers Opens. And these are the things that we're all talking about right now. So Ari, I'm so grateful that you're equipping me with information and knowledge that I can take out into the field. And with that, I'd like to introduce Ari Karen. Again, this is a special briefing, and Ari is an expert on the matters of the NAR settlement and the impact on mortgage banking. And I'm proud also to share with you all that Ari will be joining us at the Pacific Northwest Mortgage Lenders Conference, which is coming up this September. And he will have a full, general session featured speaker, and we'll be talking more about this and we'll be digging into more details. But, meanwhile, thank you for honoring us with your expertise and your presence here, Ari. I'm going to turn it over to you. I'm going to get the PowerPoint going, but I'd like to let everybody know we're going to open it up for a little bit of Q&A at the end. If you do have a burning question, please feel free to add it to the chat and I will flag it accordingly. But I'm going to help facilitate this, but I'm literally going to turn it over to Ari, and we're just going to take everything that you have to say and soak it all in, Ari. Thanks for joining us.
Well, thank you guys for having me, and I hope this will be helpful and useful information to all you guys. So why don't we jump into, if you want to put up, Andy, the presentation. So the first thing as we're putting this up that I kind of want to go through with the presentation is just, I think one of the things that we're going to first talk about is it kind of understanding what the NAR settlement does and doesn't do. You go online and you hear little snippets about it, and you don't necessarily get, all the feelings because there's different perspectives that are being sort of shared that affect what is being said. So the first thing is kind of, let's talk about what the settlement does. And just give me a second while Andy is putting that up.
Here. There we go.
Yeah, perfect. And if you don't mind just forwarding till we can get to.
There you are.
One more, please.
You bet.
And one more. There we go. Perfect. Okay. So the key thing from the settlement is that the offers of cooperative compensation can't be advertised or displayed on the MLS. Okay. That's not to say those can't exist anymore. All right. So you could still have a cooperative brokerage agreement, but it just can't be submitted out on the MLS. Now, why that is so important is that up to this point, the MLS was one of the major features of it, aspects of it was that when you went on the MLS and you decided to, go see a house, you were effectively accepting whatever compensation was offered. So you would offer an acceptance via the MLS being the utility to enforce those agreements. That can't happen anymore. So when you go see a house, right, you've got to negotiate essentially one-on-one with that agent as to whatever cooperative compensation, if any, is going to be offered. So the MLS listing no longer is necessary for an agent to get paid. It is not going to have really anything to do with the getting paid because you can't advertise the cooperative compensation on the MLS. They also said they wouldn't create a substitute for that. Now, the other things you have to conspicuously disclose and attain agreement between the seller and the seller's agent and the seller, I guess, to offer any kind of cooperative compensation. So this isn't, so now if you want to offer, 3% or 2.5% to the buyer of the home, that can't be done without the seller's written conspicuous agreement. Okay. The other thing is that buyers have to have a signed agreement with their own clients. So there has to be a written agreement with the buyer and the buyer's agent. Now, this is what I find very interesting, what's not in here. Okay. As we said, you can have cooperative compensation, and that just has to be negotiated at arm's length between the buyer and the seller, or the buyer's agent and the seller, okay, or the seller's agent. And while it says you have to conspicuously disclose to the seller any offer of cooperative compensation, there's nothing there that says you have to conspicuously disclose it to the actual buyer. So let me give you a hypothetical. If we could jump to the next slide, please. Buyer's agent goes to, look at a house with buyer. Seller's agent pulls buyer's agent aside, says, hey, if your buyer buys this, I'll give you an extra, 1%. Now, does that have to be disclosed? Now, I can give you a host of consumer protection rules that may or may not apply. I can certainly, we could talk about unfair deceptive acts or practices, all types of things, and just good old, plain old breach of fiduciary fraud, all that kind of stuff, right? I think if the buyer's agent doesn't disclose to the buyer that they're being compensated, yeah, there could be a claim. But nothing in the settlement actually explicitly states that needs to be done. And I mean, if you think about it in some ways, this is circa 2007, right? I mean, think about what's going on in the real estate industry now and compare that to what was going on in the mortgage industry in 2007. Does it sound familiar? I think so, because think about it. In 2007, 2008, right before Dodd-Frank and all the other laws, you got paid more for raising the interest rate on a buyer. And the buyer didn't necessarily, or borrower, didn't necessarily need to know. It wasn't something that was required. So now let's look at it here. Does the buyer actually need to know? Now, listen, I want to be very clear. I'm not suggesting that any buyer's agent should not disclose this because I think there could be claims. What I'm suggesting, though, is that I think there's a potential steering mechanism in play. Because now, look at it. If I'm a buyer and I'm dealing with my buyer's agent, and buyer's agent's getting 1% from person, A and 2% from person B, and they're saying, well, I really like person, house B better, but you could do whatever you want. And they may have silent incentives the buyer's not aware of. This has now been created, right? This isn't like a fictitious theoretical. This paradigm has been created, right? And you've got to remember this settlement is not a judicial. Is a judicial function, not a legislative. What I mean by that is this isn't like Congress or state legislators got together and said, hey, we should have this law. This was a plaintiff's attorney, let's be honest, trying to get paid, win their case, and defense attorneys trying to preserve as much of the market as it currently exists as they could. And they got together they're not trying to do the public good here, right? The defense attorneys are representing their client. The plaintiff's attorneys are representing their client. They're not worried about anybody else. That's not their job. And they came together with the settlement. But in situations like that, there may be very significant unintended consequences no one's thinking of. I'm identifying one for you right here, I think, because I think there's a real risk of stuff going wrong here that didn't necessarily exist before. Now, that's not to say, you know, because look, do I think that buyer's agents just going to, with their buyer, have a written agreement, tell them what they're making, and then lie? No. But where I do see the risk could be is, you know, buyer's agent has an agreement, and the little type, you know, the little print in the agreement between the buyer and the buyer's agent says, you know, this only pertains to compensation paid by the buyer and does not speak to any compensation that might be paid in cooperative, which, you know, person agrees is, you know, is okay, right? You have that type of language in there, and all of a sudden it's time to play some games, right? You could see that. So I think this is one area that really people are going to have to be careful of, because I think there is real potential for things to go wrong in the way this is now set up. Because again, it's going to be one-on-one deals, but those deals, it's not clear they need to all be disclosed to the buyer, depending on the buyer's agent agreement that the buyer signs with their agent. So kind of an interesting thing that's being put in place there. Next slide, please. Now, beyond this, what are some likely results? You know, first of all, understand the settlement is not for everybody. In other words, it only bound certain parties. So not everybody is bound by the settlement. But, you know, it is definitely not going to be an end to the litigation. Candidly, I think this might be the beginning. I think that, you know, if you really look at it, you're setting up a scenario now where we've talked about these potential silent incentives to affect things. The other thing is also you've created a scenario where there's going to be more DIY buyers. In other words, before, right, you couldn't go in and see a house because the compensation had to be arranged through MLS. Now, because that's not important anymore, the MLS doesn't do it. I can walk into a house and, in theory, represent myself in a transaction, right? And you know, from this perspective, you could have a lot of people that are not familiar with the process getting involved in it. And where that could create problems is this. I mean, think about it. One of the good things that works is for however many years this has been in place, 50 years, right? More than that, probably. You know, you had agents on one side and agent on another side, and they all kind of kept doing these transactions over and over again. Usually it's a local market, they know each other. So you're dealing with kind of known entities who work with each other, know each other, or know of each other. And there's a consistent, persistent course of dealing between the parties such that they understand what all the steps are and how it works. Enter in new people who don't do that, haven't done that, aren't familiar, and don't do it every day. And now those same ways that's the way we always do it, isn't the way we always do it. And there are going to be mistakes made, right? This is now, and you may ask, like, well, when are we going to get to how this affects, you know, mortgage bankers? Well, this is one of the places. Because what happens when you have now a DIY buyer and they start, you know, your loan officer is taking care of this transaction, and the loan officer realizes, uh-oh, they haven't ordered the home inspection, or their contingency is going to lapse, or he doesn't say anything about it, and the buyer doesn't realize it because they don't do this every day, and poof, we have a problem. Is the loan officer going to take it upon themselves to say, hey, I want to help you out with this? Because remember, loan officer wants to get the transaction done. If something blows up or doesn't happen, it's supposed to happen, then the transaction doesn't get done. But here's the other problem with that. The loan officer isn't a realtor. And as soon as the loan officer crosses that threshold, if you will, and starts advising the buyer / borrower on aspects of the deal, what happens when they don't? In other words, they kind of they fall into a trap of starting to advise on things that they're not necessarily licensed or trained upon, just to help the transaction happen, which you can't blame them for doing. But because they don't do this every day, if the buyer starts to rely on that person, whether they should or they shouldn't, and so you can see where this is going to go wrong, right? I mean, or does the loan officer say, hey, you're on your own? Or, and we'll talk about this now, do other arrangements come into fruition where now loan officers have sort of a de facto buyer's agent consultant on standby to say, hey, talk to this person if you have anything and I'll pay you to do that, or, you know, you pay them to do that, or whatever the case might be, to make sure the transaction goes as smoothly as possible. So see where that is going to open up a lot of different differentiation in terms of the way these transactions move forward, and the risks both to the seller's agent, the buyer's agent, the buyer, and the loan officer and the lender as to how all these differentiations in relationships are now going to affect transactions on a day-to-day basis. Next slide, please. Now, one of the things that I do think will happen as a result of this, like many things, I think there's going to be more regulation. We'll probably go through, a series of lawsuits, events, people claiming, the news will take on to it, and then we'll see how, there needs to be more regulation of this, because I do think that there's been some unintended consequences opened up. So I think there'll be more regulation. I think there's going to be a lot more litigation between real estate agents, and buyers, and even buyers and sellers, when when things go wrong. So, because obviously if you're a seller and your transaction doesn't go forward and interest rates rise and prices fall, I mean, now what, right? You're going to be upset that something didn't happen or should have happened, and you're going to try to find somebody responsible. It's the American way. So, I think you're going to realize you're going to see a lot more of this type of thing develop. The other thing I think you're going to see is there's going to be an influx of technology. I'm already aware of different technology solutions trying to come in and essentially come up with new pricing compensation models. I think you could have buyer's agents who say, listen, we exclusively work with buyers. We don't take any compensation from sellers. I mean, listen, you guys are all creative. You can see where there's all different types of models that people are going to be able to promote to address some fear or fiction or reality that is critical to a particular borrower or buyer in transaction. So somebody who's worried about being taken advantage of, or whether they can really trust this person, might say, hey, I want a buyer's agent who only works with buyers and doesn't take any cooperative compensation. Somebody might say, well, I just need the door opened and I'll help everything else. So I'll pay them a flat $1,000 just to open the doors for me, and I'll take care of everything else. So there's going to be all types of new models out there. And I think that's going to be a challenge, because some are going to work better than others. And again, how's that going to affect the lending on those particular transactions? Next slide. Things that I do not think that I've seen online that I do not think are going to happen: significant changes to home prices. I mean, let's all put this, in perspective here. Okay. The reality is this: tomorrow, or whatever day this is, I believe this goes into effect in a couple of weeks, but it's not like the day after this happens, all agents are all of a sudden going to change everything. Okay. I mean, you still have, agent number one and agent number two, buyer seller agent, who've done umpteen numbers of transactions together for the last 25 years. And here comes the next transaction. Are they going to change everything, or is it just going to be like, oh yeah, okay, 2.5%, 2.5%, sure. That's likely what's going to happen at first, right? It's not going to be until some of the disruptors come in that you're really going to see with these new models that this is going to start to change. But at first, it's really probably not going to change all that much. Maybe in a short time, but it's not going to be overnight. The other thing is that, again, there's still going to be compensation paid, right? I mean, somebody's being paid somewhere, and even if a seller pays 1% less, I mean, that's not really going to drive home prices. Home prices are driven by other things. Numbers of homes purchased and sold. Again, people buy and sell houses because there's divorces, people die, people get married, people have kids, right? People move, new jobs. That's not going to affect the purchase of, homes purchased and sold. Shift in the markets. Now, the idea behind this is that, certain people, because now this is going to be more of a negotiation and ongoing, there might be a way to, certain high net worth individuals might offer more for their homes to be sold percentage wise than others. I think that's pretty speculative. I could argue it the other way around, by the way, too. The reality is, obviously, if you're getting 1% and one house is $1 million and the other house is 100,000, we all know we all know which house you want to be selling, right? It's the $1 million one. So I don't necessarily see that the percentages are necessarily going to change those patterns, purchased and sold. And again, ultimately, there's only so, I mean, yeah, can a real estate agent maybe push somebody to one house versus the other? Maybe, but they can't take you from, a $3 million house to a $300,000 house. Like that's just a different market and a different person and a different everything. So it's not going to happen. So I don't really see shift in markets occurring. Changes in the numbers of agents. I look, over time, that's possible, right? But I don't think, again, this is something that's going to happen tomorrow. Over time, look, as technology comes in, there are other solutions to buy and sell houses, which are going to develop. And there's going to be, these different models. Yes, that could affect the numbers of agents, but I don't think this is something tomorrow. Now, look, I've also heard some of the, agents who are sort of reaching retirement years already who have been doing this a really long time and we're thinking of, going off to pasture, as they say, might now do that. I think that's possible that people just say, look, I don't want to, I've made my money. I don't want to do this anymore. I don't want to start with a whole new thing. I'm moving to the Bahamas. Yeah, I think, that might happen, right? There might be some of that. So I think there could be some turnover of sort of most senior agents. But that's again, it's going to depend on the person. It's very speculative, and I just don't think you can necessarily say these wholesale changes are going to reduce agents drastically overnight. I don't believe in that. Next slide. Next slide, please. So we talked about this. How could it really affect lenders? Well, first of all, I think lenders could start entering into arrangements with sellers agents, offering incentives to consumers. Now, you might say, wait, Russ, I get it. But what we're talking about here is something similar to like the scenario with the builder, where, you go to the builder and the builder says, if you use this loan officer, you'll get a $5,000 credit towards a new countertop or whatever, $5,000 towards closing costs. If the consumer is getting the benefit explicitly and only the consumer getting the benefit of it, there's nothing wrong with it. So you could enter into an arrangement with the seller's agent that says, hey, anybody who wants to put in an application to XYZ mortgage, the seller is willing to give you $3,000 towards closing. You could do that as long as it's not, something where, there's a secret interest rate, it's illusory, that you're not really getting the benefit. But assuming it's all, appropriate over the, fully disclosed, there's no problem, there's nothing secret going on. It's fine. You can do that. I think buyer's agents are also going to want to partner. Excuse me. They're also going to want to partner with lenders. I think you could see scenarios where, again, and I mentioned this briefly, where lenders may even want to have buyer's agents like part of the company almost to help DIY borrowers and to help facilitate these processes by somebody who really knows it, as opposed to having their loan officers do it. I think I know there are lenders already thinking about this and saying, hey, do I want to have some buyer's agent in-house to facilitate some of these transactions? Taking that to another step, how about certain lenders? And again, I know there's talk of this, whether anyone's going to do it. There's reasons they wouldn't, obviously. But what if they just decide to go straight, instead of being, the person who gets brought into the deal after a buyer is looking? What if they decide to go straight to the market and say, hey, work with us and we'll handle both the sale, the purchase of the property from a real estate, and we'll get you the loan. So come work for XYZ lenders, realtors, and we'll hook you up with an agent who's going to make sure that X, Y, and Z happens and all things are great, right? So it might be an opportunity for lenders to partner up with the buyer's agent and jump the market, not wait to be referred per se by a buyer's agent, but utilize the buyer's agent as a means to go straight to the consumer and get the deal. So I think that's going to happen. On the other side, I think you're going to really look at realtors looking for vertical sources of compensation. In other words, as you guys know, what was it, a year, 2 years ago almost now, maybe more, where HUD relaxed the rule about conflicts of interest, and now you can have real estate loan officers. I think you're going to definitely see some realtors looking at the opportunity to be on both sides of the transaction now that HUD allows it. So I think you're also going to see a lot more vertical integration over time with real estate companies buying real estate, with mortgage companies buying real estate companies and vice versa to vertically integrate their operations. So I see a lot of that I think is going to go on in the near term, to address the various challenges that are going to occur here and opportunities. Next slide. I kind of touched about these. So, I think that the one thing I would say is if you're looking at any of these deals, be very careful about CFPB guidance on RESPA, which you can and can't do, and get legal representation. I'm not saying it needs to be for me, but you really should before you put these together, because look, these RESPA rules are complicated, particularly when you have sort of multi-levels. Like we hear all the time, where, we go to the next slide, please, where I hear all the time somebody saying, okay, we're going to hire a real estate broker as a branch manager, and we're going to pay them $50,000 a month just to manage the branch. Now, here's the thing, and they're going to be non-producing. Here's the thing. I mean, that's not going to work. Why? Because at some point, what you have to show to comply with RESPA, you have to show that you're getting a thing of value and not just, or that you're not giving a thing of value for referral of loans. And if what's happening is the broker is sending and encouraging their loan offers to send loans to you, and that broker is getting paid, and they're really not performing the job as a branch manager, which, by the way, they're not going to perform because they're a full-time broker and they really don't know how to be a branch manager of a lender. You see where this all can go very, very wrong. So the point is, like, these are great ideas, if you don't necessarily understand the deep possibilities where things can go wrong from a regulatory perspective. And I think that's something that's going to happen if people start integrating and thinking about combining operations without getting sort of the right counsel involved to understand when something you're doing could be considered a sham for disguising a referral payment, such as a salary for somebody who really doesn't do anything all day. And these are things that can be easily caught. I had a scenario like this once in a case, and I remember that we were, I was preparing the real estate agent for a deposition, and I asked the real estate agent what's a basis point, okay, and they didn't know. Now, you can imagine if what happens when your alleged mortgage branch manager doesn't know what basis points are. Imagine that happening during a deposition. It wouldn't be well. It wouldn't go well, right? So you've really got to be careful of that. Also, be careful about required use. I've already seen this where somebody actually put on MLS and said, the only way you could do it. Now, again, I know I said, what if there's some encouragement given incentive to consumer? That's okay. But what if it's required use? What if you say, in order to apply for or put submit a bid on this house, you must get pre-approved by XYZ. Required use, that would violate Title 10. You can't do that. Affiliate business arrangement disclosures, you're going to have to give those out, and there's ones that are specific as to different states, and you're going to really need to make sure you comply with them. Because again, the one thing you don't want is a consumer not realizing this. You disclose again. After you've disclosed, close one more time, and then disclose to just make sure you disclosed again, right? I think you get the point I'm making. Licensing requirements. This is going to come up that, what happens when you have a realtor, a realtor who's also a loan officer working from the realtor's office meeting borrowers. You might have to get that location licensed. You have to look at that from state law. And then, the other thing you're going to have to consider also is redlining. I mean, this is a big thing, as you got for any lenders know, that's a very focal area of regulators. One thing we found in a lot of these redlining investigations is that what happens is that lenders get in trouble because, look, they're following the realtors. And what are the realtors doing? And again, no one's trying, I'm not saying anyone's doing anything intentionally wrong here, but okay, you're a realtor, you could sell a house for 100,000, you could sell a house for $1 million. I make a lot more money when I sell. So yeah, I'm going to go to the house for $1 million. That's what any agent would do. But if that starts to now result in, nobody being or doing business in other areas of town that aren't as affluent, do you have potential redlining considerations? Something you need to be considerate of and careful of, because it is a possibility of arising, even if it's not intentional. Next slide. Now, in doing sort of this dual employment we were just talking about, there's a couple things that you want to set up. As I said, there's no longer a conflict of interest. You do need to look at various state rules, because some state laws from a real estate perspective don't allow it. So you do have to look at the state by state. Now, there are also, prohibitions with certain investors. The USDA doesn't allow it in many cases. So you do need to understand your footprint, where you can do this, where you can't do this, and what marketing practices you have to comply with based on the states. Next slide. Now, one thing to set up and understand this is that if you do go to have a dual realtor LO, and I'm going to call them RELO, like a real estate loan officer. Let's just use that term. So if you decide to have real estate loan officers, you've got to still remember the RESPA prohibitions for referrals still exist. And there was a case called Stonebridge Title in 2014, 10 years ago, that no one really paid much attention to, and it's going to be very important now. Because what happened in Stonebridge is that they had these title agents, and these title agents were all listed as W-2 employees. Well, the CFPB came in and said, these really aren't W-2 employees. They don't have any of the incidents of employment. They're really contractors. And since they're contractors, they're 1099s, they're not eligible for a RESPA exception under employment to pay employees referral fees, which you can do under, again, if they're employees, real employees. But because in Stonebridge, they said these aren't real employees, the referral payments made to those employees were considered improper referral fees, because they were 1099s and reclassified. The lesson here is that you can, as I was using that example a minute ago with the branch manager, just call somebody employee. There's got to be true incidents of actual employment. And so you need to set your arrangements up with these individuals, your reloads, to ensure that that exists. So how do you do that? Well, first of all, when you do an employment agreement with them, make sure that they have certain specific roles in the transaction. If you ensure that they've done these certain things, and I'm almost kind of saying that old test from the 5 of the 8 things, like kind of focusing on that, right? You guys probably know about that from back in the day. But something like that, where you have specific things that are delineated that they do in every transaction. They're teamed up with a loan officer, and I mean a full-time true loan officer with background to do some of the other tasks in the transaction. And they work the RELO with the loan officer as a team to get these deals done. And they each have components and things they do. And by setting it up that way, you're creating almost a dynamic inherently that's going to create the incidents of employment that create the legitimacy, so you don't have the Stonebridge title issue. The other thing is you want to set other things up. Make sure they go to sales meetings. Make sure they have trainings, that there are performance goals for them. They have check-ins with supervisors. If you have events, sales events, or company events, they participate in that. These are things they should be made to feel and made to experience employment with your company, even if it's on a part-time capacity. Next slide. Now, the other thing is that, you've got to be careful that you've got to realize that the realtor, even when acting as a realtor, if they also have a hat that says XYZ lender, they're going to be an agent of XYZ lender, even when they're acting as a realtor. Let me give you a true life scenario. This actually happened. Now, we all know, we've all seen lots of scenarios where a lender, a real estate agent will say to the seller, they represent the buyer, oh yeah, you can use my guy. You know, he's got great credit. He's working with a great bank. There's not going to be any problem getting a loan. He's great to go. Everything's wonderful, right? And lo and behold, something doesn't go right. Now, look, if they're just a real estate agent and they have no affiliation to working with your company, this is a shrug your shoulders and be like, well, not my problem, right? Because, I mean, they don't work for me. But now let's see what happens when that person is a relo and is also a part-time employee of yours. Does the seller know when that real estate loan officer says to them, hey, this guy's going to get no problem getting approved? Does that seller know that they were speaking as an agent and not speaking as a loan officer? How would they know that? And the reality is they couldn't. So the same representations that real estate agent could have made when they were only a real estate agent that would have not affected you in any way, shape, or form now can. Because now the person sues you and says, your agent represented to me that this person, and you were the lender, was going to have no problem getting a loan. And they did. And now I'm out, XYZ dollars because of it. So you've got to be careful that the agents understand the distinctions now when they're potentially sort of having this dual role and they're an agent of yours. When they weren't an agent of yours, it wasn't a problem. When they are an agent of yours, it is a problem, even when they may not specifically be acting within the scope of the agency that you're thinking of, as long as it's reasonable for the other person on the other side listening to them to think, oh, that's the lender speaking. And if it is, you can potentially have a problem. So that's again why you want really delineated roles. You want these people really trained well. They need to understand the difference in the world when they just were a real estate agent versus a relo. There's a lot of training that has to go into this to do it safely, because there are certain risks you just can't ignore that you can't avoid. And the only way to avoid them is to minimize them by having proper training, oversight, and supervision. And that's really critical to making this work. Next slide, please. As we said, I don't want to get too far into this, but the real estate agents have to understand now that there's different roles with privacy of information, how the information could be used. You can't just go into a lender's database, pick up everybody who's applied and start sending out, hey, use me as your agent, right? We obviously understand there's permitted use of certain information and what can be shared and can't be. Can they take information and leave it at their office? When does that information have to be secured? Again, we talked about the licensure. Does the office need to be licensed? These are all things and considerations, and you've really got to train them to make sure that the rules with respect to privacy, again, real estate agents don't necessarily have access to the same level of sensitive information that lenders do. And so, even the ability to hack into a computer, or what if you have a computer that's being used for both companies and there's no firewalls up to prevent information from one being used to the other? These are all the things you really got to think about when you put these types of arrangements into place. Next slide. The other thing you got to think is, how do you structure this? Okay. So one thing, if there's only one thing you get from this session today, it's what I'm about to say. Do not, under any circumstance, use your current employment agreements with your loan officers to be the employment agreements with your relos. You need new agreements. And I'm going to explain why. Okay, we're going to go through a bunch of reasons why. But I'm just going to get to the summary of this. If you use the employment agreements with the regular loan officer for a relo, you are putting yourself into millions of dollars of potential liability. I'll show you how in just a minute. Do not use those agreements. Whatever it costs you, a few hundred, few $1,000s here, there to get them done right. If you use or reuse the wrong things, you create massive liability for yourself, even on one agreement. Again, I'll explain to you why in a second. So how do you structure these? Okay, first of all, one of the problems you have is, when is somebody working as a realtor versus an LO, right? If I'm taking a borrower/buyer into a house and we're talking about the house and how, wow, it's a pretty ceiling in the house, hey, you need a loan? You need a pre-qual? What were you doing one versus the other, right? It's impossible. So how are you going to track hours? You're not, doing one versus the other. It's going to be impossible, right? And then even if you could track hours, you're going to keep paying these people, 20 hours a week or whatever it is, if you could track it. And again, assuming they would track it, which they're not going to, you already know that. So how do you pay them? Next slide. Look, my suggestion, the only thing that I really would think could work is something like an outside sales exemption. It's not going to work in every state. I think Nebraska may have a problem with it. Arizona, some states it's a little bit harder than others. So think about that, whether you want to do the reload thing there. But I would use an outside sales exemption. And okay, I would also call them part-time. Now, the reason I say outside is, and I think you can use the outside sales exemption, that's commission only. You don't pay minimum wage. And the key thing there is you just have to ensure that the loan officer, relo, or the real estate loan officer, is going around and about. They're out of any regular place of business activity for the employer, doing their outside sales job. I think given what they're doing, that they're going to be showing houses, talking to borrowers, it can be complicated if their base office is licensed, but I think in most cases you should be able to sustain the outside sales exemption. The one thing is you don't want to give them leads. And the reason I say that is if you start giving this person leads, which by the way is the antithesis of the reason you're doing this in the first place. So why would you? But if you did, that would lead to a scenario where your relo could just sit in an office and dial for dollars for loans. And then they are not outside sales anymore. They are inside, and you lose your exemption. So don't give them leads. They're going to get their leads from their clients who they're showing homes to. Next slide. The other thing I also mentioned was to make them part-time. Now, their part-time does a couple of things. First time, it limits exposure by avoiding the possibility of overtime. So if I say you're part-time and you're only working 20 hours a week, you're probably not going to get into overtime. And even if I lost my outside sales exemption, 20 hours a week at minimum wage, it's probably not all that much. Right, your risk is somewhat limited there, right? So there's not too much to lose sleep overnight. Now, do not do this with normal loan officers, right? Because I've heard people say, oh, I'm just going to call it, look, because then it's a sham. Like if you have all these loan officers that were full-time, now you just say, oh, well, now you just work 20 hours a week. You've created a sham arrangement. Everybody knows what you're doing, and you're going to get into trouble with the Department of Labor and significant penalties for overtime, minimum wage, all those types of things. So you don't want to deal with that. But when you have somebody that you could point to, you could say, listen, this individual is gainfully employed full-time in another job. So I think it's reasonable for them to be part-time with me. I think you substantiate that in an agreement. Again, an agreement that's unique to these people that has that type of background and information in it. And now you have a basis for why you did it, and you don't have to worry about creating a sham arrangement. The other thing is, and again, remember that these have to be W-2, they're not going to be 1099. The other thing that's really important with this part-time, in addition to limiting hours, if we go to the next slide, please, is it protects you from benefits, okay? Now, here's what happens with benefits. Under the Employee Retirement Income Security Act, called ERISA, if you offer an employee benefits, well, let me start over. Employees are entitled to benefits based on the terms of certain plans. If you tell employees the wrong information about a plan, you can create liability for yourself. Let me give you an example. If you tell an employee, oh, you're not eligible for benefits under the terms of our insurance, when in fact the employee is. And that employee then goes through, can't get health insurance benefits, they have some big thing happens, and they go back and they say, well, I found out actually I was eligible. Guess who pays? The employer. Even though they didn't have health insurance, because you misrepresented to that person they weren't eligible, when in fact they were, you interfered with their benefits, and under ERISA, there could be a claim. Just to make things even easier, and I say that with great sarcasm, let's take the scenario where now you tell somebody they do have benefits and they don't. So take a scenario where you say all of our employees are eligible part-time or full-time for benefits. But in fact, the health insurance company has a provision that says only full-time employees are eligible for benefits. And you represent to somebody and they pay a premium to you, and the insurance company finds out later on, if they've got some terrible diagnosis, that, this person really isn't eligible. They can cancel the coverage, you're on the hook. So what does that say to you? So you're sort of damned if you do and damned if you don't. That's why I say if you're part-time and they're really part-time and you establish in the agreement they're part-time, and I'm assuming that as part-time employees, they're not eligible for benefits, you're in a really good place here. But going back to the point of why I said never, ever, ever use your employment agreement. I bet a lot of you guys have employment agreements with your loan officer that says something along the lines of, you are eligible to receive all benefits, including health insurance, 401k, blah, 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 right? If you write that and you give that to a relo and the relo signs it, and then the relo doesn't get the insurance because they really aren't eligible because they're part-time, guess who pays for their medical care? You do. So that is one example why you don't ever want to use these agreements. Get new agreements with people if they're going to use reloads, because by setting it up the right way, you can protect yourself from wages, overtime, minimum wage. You can also protect yourself from potential RESPA exposure, and you avoid sort of these benefits liabilities if you do it the right way. Next slide. I think we covered this already. I would say though, if you're gonna have training, make sure it's tracked. You want to be able to establish if you give somebody training that you've established it. You don't just do it and not be able to prove it. So make sure you can prove it. Next slide. I kind of already gave you this warning. Next slide. And this is really, where we can sort of conclude this if there's any questions. But, I do think there are going to be significant technology disruptors. I'm already working with certain companies that are creating, I don't want to share any details, but you're probably going to see them very soon if you haven't already, where there's going to be online shopping platforms for homes and connection with realtors and ways to see homes easier and different services you can pay to get into homes and DIY and all the stuff we've been talking about. So one thing you should definitely also look to is that the CFPB's recently in the last year or so put out some guidance on online lead shopping platforms and lead generators and how they have to be used. Make sure if you get into any of those relationships with those types of companies that you pay very close attention, because if they're doing it wrong and they work with you and you don't catch it, you're still going to get in trouble for it, even though it was their idea. And, as much as somebody might say, oh, well, we'll get indemnified from them. The problem with indemnification is it only matters if they have money to back it up, right? I mean, me telling you I'm going to indemnify you is great, but if I don't have any money, that doesn't really help you very much. So, especially with some of these startup tech companies, you really want to be careful that, you've evaluated it from your own perspective and you're not just relying upon them to conclude that, okay, it's okay to do business this way. Make sure you look at some of the guidance from the CFPB. Next slide. Kind of jump past this one. Yeah, so I think that's about it. If you guys have any questions, we still have a few minutes left.
Hey, Ari, this is Mike Golden again. Thanks so much for the terrific overview. And, this has certainly been an important topic of discussion, but also the other item that's really facing our industry here this year are the trigger lead issue. And I was wondering if you had any thoughts. Here in the last couple of weeks, there's been some discussion of sliding in Senator Reid's proposed bill into national defense funding. I'm not quite sure what trigger leads have to do with national defense, but I don't know if you have any comments on that from your perspective.
To be honest, I've just been coming out of a trial, so I really am not up to speed with that. If I certainly can give you some opinions, but I'm not familiar with the specifics of that bill. So I couldn't really tell you too much about that. Sorry, I apologize.
Oh, that's okay. Okay, thanks.
If you want to hum a few bars, I don't mind, giving you 2 cents on it.
Well, I think it was Senator Reid. They were going to put this into the National Defense Authorization Act, which apparently is a must pass for funding for a lot of items, and putting that Home Buyer Privacy Protection Act in there to help it get pushed through. But Congress is in recess now until after Labor Day, and then the session ends in first week of November. I don't know that that's gonna, regardless of where it stands, it's gonna get pushed through in this congressional session.
Yeah, the other thing is, I mean, look, obviously, we're in an election year. That's going to affect a lot of things. And, we all know that the credit agencies and the credit companies that can sell these trigger leads have a relatively successful lobbying group. And so, they probably won't necessarily be a fan of those types of provisions. So, I mean, look, I'm not a lobbyist and I can't tell you if something's going to go through or not go through. I just don't have an opinion on that. But I mean, I think, just generally speaking, massive, significant legislation tends not to pass during a presidential election cycle. That's what I've always seen. So I would not hold my breath for it.
Okay. Thanks.
All right, thanks so much for laying it all out there for us. I think, it feels like a little bit like it's the Wild West. And one thing that, really is concerning for me is the potential for people just to be easily out of compliance, whether it's knowingly or unknowingly. So I think, risk is a big consideration when it comes to any new models, new plans that are coming out. And thank you for calling that out. I guess I'm curious, where do you think the biggest immediate opportunity is for lenders? You talked about maybe partnering with buyers and, like a builder and, getting in front of it so that you can offer some kind of subsidy or concession. Do you see that as the number one opportunity? Or for lenders on the call today, what do you think would be the number one opportunity?
I'm gonna give a couple ties, and I'm sorry to not give you one clear answer here because I think the best opportunity also is one that you've got the most familiarity, right? The one that you can execute best, if that makes any sense. If I tell you to go do some type of subsidy deal that you have no familiarity with, you've never done anything with, don't know how to compute it up, then that might not be successful. But so here, what I'll to answer your question, though, I think certainly those types of relationships with buyers, agents, with directly with agents giving subsidies, consumers, I think that could be a really good opportunity because I know agents are going to want to find ways to supplement, and their business in lots of different ways. I do think as much as there is risk, if you do it the right way, and I've got a lot of lenders I'm speaking to and giving guidance on how to set up these real estate loan officer kind of dual employment relationships. If you do it right, I think that's a huge opportunity. And then, the technology, if you're able to find some of these, technology disruptors who are going to come into the market, getting connected with them. They're always looking for funding. They're always looking also for relationships that can help, establish their bona fides as they develop and get into the market. So I think those are the three main. I'm sorry for not giving you just one. I just think it depends on sort of what your interest level and experience level is. But I think dealing with, if you have a way in to start working with one of these disruptors that is going to enter into the market that you think you could be a core partner with, that would be fantastic if you can find them and know who they are and pick them right, like anything. I do think the real estate loan officer is a great opportunity for, if you, again, set it up correctly, if you're patient and you're careful, I think that could be a great opportunity. There is risk, but again, if you do it the right way. And then, like I said, lastly, any types of incentive programs that target the consumer with real estate agents, I think that's another way where, again, you could promote your business at the outset of the transaction rather than waiting for it to come to you, so to speak. So to me, those would be the three areas I'd really pay the most attention to.
Awesome, thank you. Well, I'd like to open it up to anyone else. If you have any questions, you're welcome to unmute yourself right now, throw something into the chat. You're also welcome to reach out to myself, the WMBA, or Ari directly. I have his contact information up there. And Ari, we're really looking forward to having you out to the Pacific Northwest Mortgage Lenders Conference. I'm going to quick switch and then I'll move it back over to your contact. But real quick, everybody, the Pacific Northwest Mortgage Lenders Conference is happening September 22nd through the 24th here in Seattle at the Seattle Sheraton downtown. And we are going to have a day and a half. It's actually a Sunday night, full day Monday, half day Tuesday, jam-packed full of valuable information like this that matters to all of us. So I would encourage you to reach out, register today. We have sponsorship opportunities. Like if you feel like this is a great topic that your company wants to get behind, we can sponsor Murray and his speaker role in particular. Otherwise, we have a whole lot of other opportunities. And you know, our goal here at the WMBA is to continue to bring you information, educate all of us, and hopefully inspire further engagement, because we're all in this together advocating for homeownership. And this is the Wild West, like I said. We don't know where this is all going, but I guess I do have one more question, Ari. With regards to the overall landscape and the negotiations, we're gonna have a lot of people that do not know what to do or how to do it. Do you have any advice for a first-time buyer or actually a home buyer that's looking to, maybe they've been in their house for 20 years and now they're looking to downsize, for example? What would you recommend? How would they approach this process now that the NAR settlement is about to be in full effect?
You know, honestly, I'm going to give really boring advice here. Get an agent. And I mean, that's where the problem's going to be. It's going to be people who, you know, think they can do it on their own. And it's the old saying I've heard it a million times. You probably have too. It's the question you don't know to ask that gets you, right? That's the problem. It's when you walk down and you don't know there was a deadline for actually getting that financing contingency removed, right? And then lo and behold, so I think somebody who, you know, thinks they're familiar with the process, but really they're not, that's where the danger is really going to come in for people. So I would say for somebody like you, explained, who wants to downsize, who isn't really sophisticated, and maybe even for people who are, right, sophisticated, maybe it's just better that you use the people who have the expertise, even if it's going to cost you an extra percent, because look at the reality, right? Buying, selling a home for most people is the largest single financial transaction they will ever engage in, and it can have the greatest effect on their ultimate wealth or lack thereof, right? For 1%, I don't know. So that's sort of my advice to those people.
Well, thanks for that. I do appreciate it. And, you know, whether it's an MSA or a dual role, and all of those things just open up a lot of compliance and risk potential. And, you know, everything that I've been hearing so far, and you've, like I said, equipped me a little bit more to go out into the field. But this is a significant opportunity for lenders to become an expert on this topic and then position themselves not only with their partners as, hey, I'm going to do, I see reasons why it's more important than ever that we team up with partners and we promote the realtor partners to do their job and let's do our job. And together, you know, two heads are better than one in this situation. Two experts in their fields are better than one. So I think that's a significant opportunity for us as lenders, is to really articulate our value proposition to help promote and sell our partners and us together. Like, our partners are going to appreciate it. So that's an opportunity right there. And you don't have to engage in those other potentially risky opportunities.
That's absolutely true. I do agree with you.
Okay, well, I tell you what, guys, we're gonna share this link and we will be promoting it on the WMBA's website, but we'll also promote it in social media. I think that more people need to hear from you, Ari. And as we mentioned, we really appreciate you stepping up and joining us today. We really appreciate Mike Golden and Art for everything that you guys do and bringing Ari to us. And again, you know, we feel like we're more empowered today with more information and more knowledge to go out and be a better loan officer and be a better lender.
Great. Well, thank you for listening today. I appreciate it. Hope it's helpful.
Awesome. Thanks, Ari. And we'll see you in September.
Sounds great. Look forward to it. Bye, guys.